If you're watching silver prices right now, you might be feeling a bit dizzy. And honestly, I don't blame you. Just 10 days ago, on January 29th, silver hit an all-time record high of $121 per ounce. Let me repeat that because it's absolutely insane, $121 per ounce. And today, we're sitting at around $78. That's a 40% crash from the peak. In fact, silver experienced its biggest one-day drop since 1980, losing almost 30% in a single trading session. So what the heck just happened? That's exactly what we're going to break down today, and more importantly, where silver might be headed next. Stay with me because this story has more twists than a thriller novel. Before we dive into the crash itself, let's get some perspective here. Yes, silver just fell 40% from its peak, and that's absolutely brutal if you bought at the top. But here's something that might surprise you. Even after this massive sell-off, silver is still up 145% compared to where it was a year ago. Think about that for a second. If you had bought silver in February 2025, you'd still be sitting on incredible gains right now. So this isn't just a story about a crash. It's a story about an absolutely explosive rally that went parabolic, then came crashing back down to earth. The question is, was this just a speculative bubble popping, or is there something more fundamental going on? Let me take you back to how we got here. Throughout 2025 and into early 2026, silver was on an absolute tear. The metal was benefiting from a perfect storm of positive factors. Industrial demand was surging, particularly from the solar panel industry, electronics manufacturing, and the build-out of AI infrastructure. Here's a number that really puts this in perspective. More than 50% of silver demand right now is industrial. This isn't just about people buying coins and bars to store in their safe. We're talking about real, tangible demand from industries that are shaping our technological future. Solar panels alone require significant amounts of silver for their photovoltaic cells, and with the global push toward renewable energy, that demand has been growing rapidly. At the same time, supply has been relatively constrained. Silver mining isn't easy to ramp up quickly, and many of the world's silver deposits are becoming harder and more expensive to extract. So you have this classic setup of rising demand meeting limited supply, and prices started climbing. But then something else happened that turbocharged the rally: speculation. And not just any speculation, but heavy buying from Chinese traders who piled into silver futures and derivatives. When you combine genuine industrial demand with aggressive speculative positioning, you get the kind of explosive move we saw pushing silver all the way to $121. Think of it like a rocket ship. The industrial demand and supply constraints were the solid fuel providing steady thrust upward. But the speculation? That was like strapping a nitrous boost onto the rocket. It sent prices absolutely screaming higher, much faster than fundamentals alone would justify. And here's the thing about rockets with too much nitrous: they tend to explode spectacularly. So what caused the explosion? Well, on the surface, you can point to one specific catalyst: the nomination of Kevin Warsh as the next Federal Reserve Chairman. Now, you might be wondering, why would a Fed chairman nomination cause silver to crash? Great question. Kevin Warsh is known as a hawk when it comes to monetary policy. He's got strong views against the Federal Reserve maintaining a large balance sheet, which essentially means he's likely to favor tighter monetary policy, higher interest rates, and a generally stronger dollar. When his nomination was announced, the market immediately started pricing in what this would mean for precious metals. Here's how that connection works. Precious metals like silver and gold typically move inversely to the US dollar. When the dollar strengthens, it makes these metals more expensive for foreign buyers, which dampens demand. Also, when interest rates are higher, the opportunity cost of holding silver increases. Unlike bonds or savings accounts, silver doesn't pay you interest or dividends. It just sits there. So when rates are low, that's fine. But when rates start climbing, investors start asking themselves, why am I holding this metal that pays me nothing when I could be earning 5% or 6% in Treasury bonds? The Warsh nomination triggered exactly this kind of thinking, and the dollar immediately bounced sharply higher. That put enormous pressure on silver prices. But the Warsh nomination alone doesn't explain a 30% single-day drop. To understand that, you need to know about what happened with margin requirements. The Chicago Mercantile Exchange, the CME, is where silver futures contracts are traded. As silver was hitting those record highs around $121, the CME made a decision that would prove absolutely devastating for over-leveraged traders. They increased the margin requirements for silver from 11% to 15%. Now, if you're not familiar with futures trading, let me explain why this matters so much. When you trade futures, you don't need to put up the full value of the contract. You only need to deposit a percentage as margin. At 11% margin, you could control $100,000 worth of silver with just $11,000. That's almost 10 to 1 leverage. When the CME raised that requirement to 15%, traders who were already maxed out on leverage suddenly didn't have enough margin in their accounts. They received margin calls, which means they had to either deposit more money immediately or close their positions. And here's the brutal reality. When you're trading with that much leverage and the market starts moving against you, most traders don't have extra cash sitting around to meet those margin calls. So what happens? Forced liquidation. They have to sell, regardless of the price. And when thousands of traders are all forced to sell at the same time, you get what's called a cascade or a waterfall effect. Selling begets more selling, prices drop further, triggering more margin calls, causing more selling. It becomes a self-reinforcing downward spiral. This is exactly what we saw on that brutal day when silver lost 30% of its value. The combination of the Warsh nomination spooking the market, the dollar surging higher, and margin requirements forcing massive liquidations created a perfect storm of selling pressure. And because silver has a relatively smaller market compared to gold and much thinner liquidity, the price moves were absolutely violent. When everyone tries to exit through a small door at the same time, people get trampled. That's essentially what happened in the silver market. Now, you might be thinking this sounds familiar, and if you know your precious metals history, it should. The biggest one-day drop in silver before this recent crash happened back in 1980. That was the infamous Hunt Brothers collapse. For those who don't know the story, the Hunt brothers tried to corner the silver market by buying up massive amounts of physical silver and futures contracts. They drove prices from around $6 to $50 per ounce. But then, just like now, margin requirements were raised, and the whole scheme collapsed. Silver crashed spectacularly, and the Hunt brothers went bankrupt. The parallels aren't perfect. We don't have anyone trying to corner the market this time. But the dynamics of over-leveraged speculation followed by forced liquidation are remarkably similar. So here we are today, with silver trading around $78 to $79 per ounce, depending on the time of day. The question everyone's asking is, what happens next? And this is where things get really interesting because there are compelling arguments for multiple different scenarios. Let me walk you through the thinking on each side. First, let's talk about the bullish case. Despite the crash, the fundamental drivers that pushed silver higher in the first place haven't disappeared. Industrial demand is still strong. We're not suddenly going to stop building solar panels or manufacturing electronics. The AI infrastructure build-out that requires silver isn't going away. Supply is still constrained, and mining companies can't just flip a switch and produce more silver overnight. From this perspective, what we just witnessed was a washout of weak hands and over-leveraged speculators. The market got cleaned out, and now we can rebuild on a more solid foundation. UBS, one of the major investment banks, is actually quite bullish. They're forecasting that silver will return to the $100 level by next month, March 2026. That would represent about a 25% gain from current levels in just a few weeks. Their thinking is that once the panic subsides and the forced selling is complete, buyers will recognize that silver is now significantly cheaper and represents good value given the underlying fundamentals. However, UBS also predicts that after touching $100, silver will fall back to around $85 by the end of the year. So even the bulls aren't expecting us to immediately rocket back to $121. There's recognition that the speculative froth has been blown off, and it will take time to rebuild that kind of momentum. But the key point from the bullish perspective is that the structural trend remains upward. This was a violent correction within an ongoing bull market, not the end of the bull market itself. Now let's consider the bearish case, because it's important to hear both sides. Goldman Sachs, another major player, is notably more cautious on silver compared to gold. Their concern centers around what happens when prices get too high. Remember I mentioned that more than 50% of silver demand is industrial? Well, here's the thing about industrial users. they're price sensitive. When silver was at $30 or $40 per ounce, manufacturers could absorb that cost. But at $80, $100, or $121, companies start looking for alternatives. They optimize their processes to use less silver. They explore substitute materials. They pass costs on to consumers, which reduces end demand for their products. From this perspective, rising silver prices contain the seeds of their own destruction. The higher prices go, the more they incentivize reduced consumption, which eventually caps further gains. Additionally, bears point out that if Kevin Warsh actually becomes Fed chairman and follows through on hawkish policies, we could see sustained dollar strength and higher interest rates, both of which would be headwinds for silver. Then there's a third possibility that's perhaps most likely in the near term: sideways consolidation. After such a violent move, both up and down, markets often need time to digest what happened and establish a new equilibrium. We could easily see silver trade in a range, say between $70 and $90, for weeks or even months as the market figures out what the fair value really is. This consolidation period would allow some of the shell-shock traders to lick their wounds, new buyers to carefully accumulate positions, and industrial users to adjust their purchasing strategies. There's also a timing factor we need to consider. The Chinese New Year is coming up, running from February 16th to the 23rd. During this period, Chinese markets are closed and trading activity from that part of the world drops significantly. Since Chinese traders were a major part of the speculative buying that drove silver to $121, their absence could mean reduced liquidity and muted price action in the coming weeks. It's hard to see silver making any major moves during a period when such a significant portion of market participants are on holiday. So what should you actually do if you're an investor or trader watching all this unfold? Well, that depends entirely on your time frame, risk tolerance, and what you're trying to achieve. If you're a long-term investor who believes in the fundamental case for silver, the industrial demand story, the constrained supply, the role of precious metals as a portfolio diversifier, then this crash might actually represent an opportunity. You're getting silver at nearly half the price it was just 10 days ago, and the factors that support long-term demand haven't changed. Dollar cost averaging could make a lot of sense here. Instead of trying to catch the exact bottom, you gradually build a position over time, which smooths out your entry price. For those holding physical silver, coins, bars, that sort of thing, the calculus is a bit different. You're not going to get a margin call on physical metal sitting in your safe. The psychological challenge is whether you can stomach watching the value of your holdings swing wildly. If you bought physical silver years ago at $20 or $25 per ounce, you're still sitting on substantial gains even after this crash. The question is whether you believe silver is going higher from here over the next few years, or whether you want to lock in profits and move on to other opportunities. One thing I want to emphasize is that nobody, and I mean nobody, can tell you with certainty where silver is headed next. Anyone who claims they know for sure is either lying or delusional. What we can do is look at the data, understand the factors driving the market, and make informed decisions based on probabilities rather than certainties. The data tells us that silver is incredibly volatile right now, that there are genuine fundamental supports for the price, but also that speculative excess got way ahead of those fundamentals. That suggests a bumpy road ahead with significant risk in both directions. What's clear is that the silver market is at a fascinating inflection point. We've just witnessed one of the most dramatic crashes in the metal's history, but we're still well above where prices were a year ago. The industrial demand story is real and growing. The supply constraints are real, but the speculation and leverage that pushed prices to $121 created an unsustainable situation that had to correct. Now, with much of that excess wrung out of the market, we get to see what silver's true value is when it's not being distorted by extreme speculation. My guess? We're going to see continued volatility, probably a period of consolidation, and then eventually a test of whether silver can rebuild momentum and challenge the higher levels again, perhaps on a more sustainable basis this time. The next few weeks are going to be really telling. Watch how silver trades during the Chinese New Year period. Watch for any further comments or actions from the Federal Reserve regarding policy direction. Watch the dollar. Watch industrial demand data. All of these pieces will give us clues about where we're headed. And most importantly, Watch your own risk tolerance and don't get caught up in the hype, whether it's bullish or bearish hype. The traders who survive and thrive in markets like this are the ones who stay disciplined, manage their risk, and don't let emotions drive their decisions. So that's the story of silver's 40% crash from $121 to where we are today, around $78. It's a tale of fundamental demand meeting speculative excess, of margin calls and forced liquidation, of Fed policy and currency dynamics, all colliding in one of the most volatile episodes the silver market has ever seen. Whether you see this as a buying opportunity or a warning sign probably says more about your investing philosophy and risk tolerance than it does about silver itself. What I do know is that this is a market that demands respect. The gains can be spectacular, but the losses can be equally devastating. If you found this breakdown helpful, please hit that like button and subscribe to the channel. I want to hear from you in the comments. Where do you think silver is headed next? Are you buying this dip, or do you think we've got further to fall? Let me know your thoughts, and let's continue this conversation. Thanks for watching, and I'll see you in the next one.